So far, I've talked about what we want to study when we're researching a business, where we get that information, and how we get the initial idea in the first place for which stock we want to study. In this video, I want to talk about what I actually look for when I'm trying to make an investment. First, I'm going to talk about what I want to see in the company that I'm going to invest in. Then I'll talk in the next video about what I want to see in the stock I'm going to invest in. Remember that a stock is a piece of a company. The stock represents the price in the equation, and the company represents value. So I want to identify what sort of value I'm looking for, and then I'll talk about what pricing I'm looking for. I'm looking from my perspective as a value investor who does understand the importance of growth and quality, but focuses more on understanding what's a good price to pay for something. This isn't a strict checklist. Not every investment I make will fit all of these boxes, but they're 4 good guidelines of things I'd like to see in the company before I make an investment. The first thing I'm looking for is growth. By that I mean revenue or sales growth. That doesn't mean that it shouldn't translate to earnings or to profits, and I will talk a little bit more about that later, and I'm sure in other videos. But the first thing I want to see is, can this company sell more of whatever it's making or offering this year than it did last year, and next year than it did this year? That's a good sign that their quality of their product is high enough that they can either find new customers, which is the best, sell more to existing customers, which is okay, or raise prices, which all companies tend to do, and that's fine, but if they're reliant on that, it's a little bit more worrisome. In any case, revenue growth is a basic sign of quality, a basic sign that the company is offering something that matters and that they can build on. And that probably means they have some sort of competitive advantage or something working in their favor that would lead to customers deciding to go with them. My second criteria sounds obvious, but I want to be able to understand the business that I'm going to invest in. I want to understand the key variables that will drive its success or failure in the next year and the years ahead. I want to be able to understand how it actually makes its money, what's its process for selling, what is its drivers of sales and then of profits. And I want to understand its competitive advantage and how the industry as a whole generally works. I'm never going to be the expert on a stock, but I want to be able to explain what the company does to a 5-year-old. The old explain it like I'm 5 test. If I can't succinctly explain what is it that this company does and how does it make money, then I probably don't understand it well enough to invest in. For example, I don't understand biotech at all. I don't know why a company would or wouldn't pass a trial, and so much of the stock movement is based on that sort of event, so I don't invest in biotech. I don't understand commodity prices and what drives them in the medium to longer term horizon, and I don't understand how one oil company is better than another well enough, so I leave commodity companies alone for the most part. I don't even understand healthcare, which is very complicated in terms of how the US government will reimburse certain companies or certain procedures. And so, again, as a rule, I tend to stay away from healthcare. But there are things that I can bring to the table. I have experience in the subscription business world, so any company that's making a subscription product transformation, I can put my expertise on that. This sounds a little bit like Peter Lynch, but it's a little bit different. There's a concept Lynch probably talked about, but Buffett is most famous for popularizing, called the circle of competence. The idea is if you stick to companies that you understand and really know, you'll have more chances of success. I think this is a logical concept. I like to think about it as a circle of interests. Which sort of industries and companies are you interested in learning about? Because I always want to learn more. I don't want to restrict myself to a narrow circle. If I can learn about a new industry, that's great. And so I explore industries in places that I'm interested in. I'm interested in travel, so I spend a lot of time on travel companies, and I've invested in a lot of travel-focused companies. There are a number of other industries that I do have interest in and that I can understand to one point or another. And I think it's a key gating factor for you to figure out is which businesses can I actually understand? How is it they make their money? How is it they will have more success or less success next year? If you can have that in your mind and you can figure that out, you have a better chance of making a good investment. I like to see a company that controls its own destiny as much as possible, by which I mean 2 things. First, I mean financial control. I want to see a strong balance sheet with more cash on it than debt, ideally, and positive free cash flow, or at least a sign that there will be positive free cash flow in the next couple years. If a company has this, it doesn't need to raise more money from the markets, which means even in extreme conditions, when stocks sell off, when interest rates are not welcoming, that company will be fine. In fact, good companies' stocks still sell off in extreme conditions, and that's often when they become really attractive. Because the company doesn't need to raise money, it doesn't matter to them that the stock is down temporarily. That's a huge advantage, and that's the sort of company I like to be invested in. Then I talk about operational control as the second part of controlling your own destiny, which is a harder thing to define and it's trickier. The business world is volatile and no business is an island. No company is truly independent of all its environment. That said, what I mean by this and what I'm looking for this is it's easier to explain in the reverse. I'm looking to avoid companies that are overly reliant on the help of strangers or on outside forces. If a company is solely reliant on the price of oil or on one or two major customers, or let's say it relies on SEO on Google and any Google algorithm change is a game changer for the company, those are the sorts of companies that you want to be careful about investing in because before you know it, that advantage could melt away because of one of those factors changing. Ideally, a company that has a competitive advantage that's durable is not relying on too many other external forces, or at least not on such a concentrated way. If they're more diversified in their exposure, then one bad thing can happen and they can recover from that without torpedoing the business. Again, this is a hard one to nail down. It's probably the most challenging to analyze, but I ideally want to find companies that have this sort of profile rather than ones that are overly exposed to one or two major providers or risks, things like that. All things equal, I want to invest in businesses that are more efficient than their peers and more efficient than the average company. By efficient, I mean that they have higher margins, they make more dollars on the sales, they have less costs than their competitors, and low capital expenditures, that they have to invest less in the property of their business, that they have more cash left over to return to shareholders or to put on the balance sheet. Those are the sorts of companies I'm most interested in. Like with most of what I'm talking about, there's no hard and fast rule, and in fact, you can reverse this. Jeff Bezos of Amazon famously said that your margin is my opportunity. A company with a high margin may attract competitors. If they see that there's 25% margins in this business, they might think, oh, it's worth it for us to try to get that 25% margin. Or even if we get 20%, we'll be happy. So margins attract competition. Low capital needs, low capital expenditures means that it's easier to enter a business as a rule. Software businesses are easier to spin up from the ground than it is to build an aircraft manufacturing business. Boeing has a wider moat because they spend a lot of capital expenditures and it's a different sort of business. So there's a balance in this. One business that I'm invested in that I've mentioned before is Charles Schwab. Charles Schwab has had a lot of success because they're asset heavy. They have a lot of assets. So they're less efficient than some of their peers, but it gave them more muscle to swing around. And so when they cut commissions to zero in 2019, it sent a shockwave through the industry and let Charles Schwab consolidate more power. They ended up buying TD Ameritrade. As always, no rule is hard and fast, but I think generally, all things equal, a company that's more efficient, it's a sign that more of that revenue growth, which we talked about at the beginning, is going to return to the shareholders or grow the business over time as the company invests in itself the way an Amazon has, so that it will continue to have success in the future. The four things I mentioned here are best case scenarios. As I said at the top, this isn't a checklist, it's just the scope of what I'm trying to find. After we figure out how good the company is and how many of these boxes it can check or how it checks off against all of these points, we can then look at the stock to see if the price is reasonable. And there's a sliding scale there. The better a company is, the more you're willing to pay a price for it. And the worse a company is, the more of a discount or more of an attractive price you need. I'll talk about that in the next video. Stay tuned for more on what I look for when I'm buying stocks. Check out Short Investing Guide for the full guide to how to buy stocks. And thank you for watching. I hope to see you next time.